the belief that we basically are not going to have a recession because it hasn't happened already is like saying in Toronto, Canada, it didn't snow in December, therefore winter's been called off. It's actually very unnerving how investors are positioned right now. And instead of taking profits on what they've on their long position, it looks to me going into this year, everybody is doubling up at these valuations. But that's the belief mechanism: no recession, rates coming down, inflation melting. The sky's.
David Rosenberg, the insightful founder and president of Rosenberg Research, delves into intricate economic indicators, providing a comprehensive insight into the economic landscape of 2024. In this discussion, he also explores the significant influence wielded by the Federal Reserve over the markets. U.S. Treasuries rebounded and stocks climbed after fresh data revealed a significant slowdown in the country's vast services sector in December. This boosted hopes that the Federal Reserve might soon initiate interest rate cuts. Rosenberg highlights a crucial aspect that hasn't yet clicked within the stock market. Wall Street's benchmark S&P 500 rose by 0.5%, while the tech-heavy Nasdaq Composite gained 0.6%. The underlying reason behind the expected decline in interest rates is illuminated by December's jobs report. Employers added 216,000 jobs for the month, with the unemployment rate at 3.7%, surpassing estimates of 170,000 jobs and a 3.8% unemployment rate. Despite inflationary pressures receding in other sectors, the labor market still exhibits prevalent inflationary tendencies. Average hourly earnings rose by 0.4% in the month, marking a 4.1% increase from a year ago, higher than estimates of 0.3% and 3.99%, respectively. The average work week edged lower to 34.3 hours. David suggests that the potential surprise of the year could be the downward trajectory of earnings expectations, signaling a possible economic shift towards a recession. This scenario notably eluded realization in the previous year. Now, let's delve into the video, but before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
So I think what the stock market has on its mind is a perpetual soft landing, that the growth could be meager but still positive, but we're going to come out of this with lower inflation and lower interest rates. And so the stock market spent most of the past few months, especially since the Fed started pivoting in its language, basically rejoicing over the prospect that interest rates are going to come down and perhaps forcefully in 2024. What the stock market hasn't caught on yet is why it is that interest rates will be coming down. And that's where we get into the big surprise for this year is going to be how earnings expectations come down and how the economy very likely morphs into that recession that miraculously didn't happen last year. And I'll tell you why. When you're taking a look at the earnings, if you had to normalize the multiple, which I said is pressing against 20, which is super elevated, the long run mean is closer to 16 or 17. So if you normalize the multiple, it's telling you that there was 35% earnings growth embedded in equity valuations. Does anybody really think we're going to have 35% earnings growth next year? I highly doubt it. And the consensus is for earnings growth to be up more than 10% next year, at a time when the Fed's dot plot forecast for nominal GDP growth is less than 4%. You're not going to grow earnings 6 percentage points this year above where nominal GDP growth is. So I think that that's really going to be the two major things here will be earnings estimates will be coming down. And at the same time, I think the markets will be grappling with, and now that they priced in the lower rates, they'll be pricing in why are these rates coming down. And it's very clear to me that the Fed is seeing something in the economy that isn't readily apparent in the government economic data releases that have been coming out. And if you go to the Fed's Beige Book, which is the most comprehensive set of economic information that comes out every 6 weeks in the U.S. economy, you're going to see that by late November in the last Beige Book, 2/3 of the economy were already either in stagnation mode or contracting outright. It was actually the weakest beige book that we've had that I can remember since the dark days in the winter and spring of 2020. The tone of the beige book was weaker than it was heading into the 1990 recession, the 2001 recession, the 2008 recession. And the Fed has already told us that they're paying more attention to business contacts than they are to the government data, which is getting revised consistently to the downside over the past few months. So that, I think, is going to be one of the stories that we'll be talking about. We spent the last few months talking about interest rates coming down. People will say, well, that should justify the multiple where it is. And I would say, well, the next phase of the story, the next chapter will be why are rates going to be coming down in 2024? And it's because the recession that everybody missed last year, much like everybody missed the 2007 recession. Remember what happened in 2008? Everybody missed the recession in 2000. It came in 2001. These are just lags. So I think my biggest concern is this excessive complacency in the marketplace right now. That has me very unnerved.
David Rosenberg points out the inconsistency between the anticipated downward trend in inflation, potentially dropping from 9% to nearly 0.1% by the year's end, and the expectation of double-digit earnings growth. Federal Reserve Chair Jay Powell ended 2023 on an optimistic note, delivering a dovish message on December 13th. Forecasts indicate that most rate setters are now firmly in the soft landing camp. The Federal Open Market Committee, responsible for setting rates, believes that unemployment will only rise slightly above current levels as inflation makes progress towards stabilizing around the rate setter's target of 2%. Despite some mitigating factors in the past year, Rosenberg remains cautious and anticipates that the consequences of the Fed's actions are poised to challenge the economy in the upcoming months. Now, let's shift our focus back to the video.
Inflation is coming down. Inflation represents pricing power. And so when inflation is coming down, we've come down a long way from 9% down to 3%. I think we'll be down close to 0 or 1% by the end of this year. That doesn't really speak to how we're going to get double-digit earnings growth unless there's going to be massive cost cutting. How are you going to get, in a declining inflationary environment, we're already down to 3%. How are you going to get 10% growth? That's basically the analysts' projections or the 30% plus that's embedded in equity valuations. How are you going to get there in a declining inflationary environment unless you cut costs dramatically? And if you cut costs dramatically, the cost cutting is actually what ends up tipping the economy into recession. So I think you're quite right. The logic is very circular. But since when did the stock market really ever have to have a lot of logic attached to it? A lot of this is just animal spirits. You go on CNBC, or you look at Fox Business, or you go to Bloomberg TV. 95% of the time, it's just the equity market that's up on the screen. You rarely see anything on corporates. Treasury yields will pop in. It's all about the stock market. But I mean, what are you going to do? I have clients and non-clients for the past couple of years. Well, not so much in 2022 since it didn't work, for 9 months of the year. But FOMO is FOMO like? Do they teach FOMO when you do your CFA classes? In the Graham and Dodd book on value investing, does FOMO show up? FOMO or TINA or dry powder? I think I used that term earlier. I mean, FOMO, fear of missing out. TINA, there is an alternative. This is today's investor, right? It's become, tell you the truth, it's become a bit of a game and a bit of a casino. When I started in the business in the early to mid 80s, equities, nobody was too fussed about being a month behind your bogeys or a quarter. People had a long-term view. Today, long-term view on equity investing is lunch tomorrow. It's become more of a trading vehicle, or as you saw with the meme stocks, a get-rich-quick scheme. Historically, the stock market was a means for companies to issue equity to finance capital investment. Who does that anymore? The companies are buying back their stock. They don't issue stock for capital investment. And then on the investor side, it's become almost like a get-rich-quick scheme as opposed to building wealth over time. So I'd say yes. So, the market heading in the final few months of last year caught on to this Fed verbal pivot. And if it was a case where they were thinking, I'm talking about the equity market crowd, that, this is a Fed easing cycle that is going to involve a recession, it would mean, get out of Dodge quickly, because in recessions, the stock market goes down between 20 and 30%. And you could argue the recession hasn't started yet. There's some measures that suggest that it may have. Most have suggest that it hasn't. But the reality is that if we get a recession, and I don't believe the business cycle has been repealed, and I don't believe in new eras. We get the recession, and that's still my base case. I know I was talking about it last year, but last year there were some special factors at play that mitigated the lags from what the Fed has already done. Those lags still are going to be confronting us, and there's going to be a mountain of rollovers on commercial real estate and corporate debt that's going to impair the economy in the coming year. Debt servicing costs, no matter what happens with interest rates, are going to be siphoning off money in the private sector that would otherwise go into spending, which is part of GDP, and into servicing the debt. That'll be a big story for the coming 12 months.
According to a survey by Walters' CLU Blue Chip Economic Indicators in early December, prior to the Federal Reserve news on December 13th, forecasters projected a 1.3% expansion of the economy for the current year. This estimate reflects a decline from the previously anticipated 2.4% growth in 2023, but surpasses the earlier 0.7% estimate made in July. If the Federal Reserve's wish comes true, and its shift into the soft landing camp proves correct, there may be satisfaction with the easing of financial conditions. Your input is highly valued, so feel free to share your thoughts in the comment section. If you found this content helpful, show your support by giving it a thumbs up. Remember to subscribe to stay updated. Thank you for being a part of this journey with us.